My next guest says this record-setting rally could be running out of runway. Joining me now is Kevin Simpson. He is the founder and CEO of Capital Wealth Planning. It's good to see you. Why are we running out of runway? Some say we've got a lot of room left to go here.
I think over the longer term, intermediate term, absolutely, we've got longer, higher and better. But over the short term, I think volatility is going to play a bigger part. Obviously, with the election, there's going to be tremendous volatility, at least within the headlines. But just looking at how stocks are priced, Scott, since February, we've been very, very range-bound. The Dow's up 5%, the equally weighted S&P's up 5%, maybe 4 or 5% in that range. Most of that return came in January and February. We know the AI story. I mean, there's nothing more to talk about the fact that they're pulling everything higher within the broader indices. But I just think that markets are priced to perfection right now for most of the market, for most stocks. And if we get a little volatility, if we get a little air pocket, I think it's a buying opportunity, not something you're trying to time or sell the news. But I just think with the market that hasn't given us a 5 or 10% pullback in seemingly so long, that we may see some opportunities here in the shorter term.
How could we be priced for perfection in so many stocks when so many stocks haven't performed nearly as well as the mega cap tech ones have?
Yeah, you know, there's absolutely value in some of the names that we own because their earnings have gone higher and their stock prices haven't moved. They've been buying back shares, so their PE ratios have come down a little bit. I think I'm talking more just a broader index because you talked earlier about the market calls of 5,600, 5,800, 6,000 on the S&P. So much of that earnings is fueled by the big tech stocks. Here we are in July. We can start looking forward to 2025 earnings, but they need to be the big boys here. They need to be the ones to carry that market. So for the broad indices, I think they're very close to perfection.
Oh, I got you. I got you. I mean, that's precisely why some always point to the outperformance at the index level versus the individual stock level when looking at year-to-date performance of the markets themselves. Now, let me ask you this, because I look at your holdings, okay? And, you know, unlike many that we've been speaking to lately anyway, you hold a bunch of stocks in a wide swath of areas, right? You got Caterpillar, Conoco, Walmart, Verizon, TJX, Procter, Honeywell, Home Depot. I've only named a smattering of the ones you have. My point is they're outside of mega cap tech, yet you suggest to our producers outside of AI there's not much compelling or that we feel that we need to own or rush to own in any way. Man, if that doesn't say what the current market environment feels like, I don't know what does.
Yeah, you know, it's been like that for 2 years, so maybe I've got PTSD with these value names. But if you look at this week, truth be told, we had a half-day Wednesday, a lot of people playing hooky today. It was a huge day today for economic data. We'll get that digested by the markets, I think, on Monday, Tuesday, and Wednesday. You look at the ISM manufacturing on Monday, not great. ISM service on Wednesday, like contracture, like very much in contraction territory. If you strip out the COVID years, it was like the worst print we've seen since 2009. So it shows the economic growth is slowing a little bit. And I think that's what the Fed expects. Today, the jobs number was really good from the perspective of what the Fed wants to see, 4.1% unemployment. It's not horrible, but it's looking at that dual mandate, jobs, inflation, and inflation is coming down, even though it's stalled for a while. So the good news is bad news mantra holds for now because it gives the Fed the ability to move forward the rate cuts. I think after today, December is like a sure thing. September still maybe 50-50. It's going to be data dependent. I don't think they're going to rush into it. I listened to the great interview with the professor. I understand the theory that sooner the better so that you don't run the risk of tripping over a recession before you start rate cuts. But I don't know that if a September rate cut's the first one or a December, it's going to make that much of a difference. I think the idea that you're going to see at least one rate cut this year is constructive. The market is absolutely pricing in too, Scott.